Good day, everyone. My name is Hannah Atomode. Welcome to this episode Talk Insurance with Hannah. On this channel, we demystify insurance terms and we help you with your insurance decision. So, on this episode, we will be talking about life insurance because that was where we stopped from the last episode. So, talking about life insurance, I know from my introduction, I laid an emphasis and I made it known that there are three types of life insurance: whole life insurance, term life insurance, and endowment life insurance. So, I'll be talking about whole life insurance first. For whole life insurance means that when you have paid your premium, your beneficiary gets a sum assured at your death. So irrespective of when the death comes, even if after you have paid the premium, the policy period has expired and you outlive this period where you are paying premium and death comes anytime, your beneficiary is entitled to a sum assured. So some people may have a whole life plan and they may say they want to pay premium for 5 years, they want to pay premium for 10 years, they want to pay premium for 15 years. So when death comes during this period of 5 years that you have chosen, your beneficiary gets sum assured, and after the 5 years that you have finished paid in the premium, the beneficiary still gets a sum assured. That is what whole life policy do. So you propose what you want your dependents, your beneficiary to get at your death. They are going to put it on a calculator which they will determine what you're going to be paying every month, yearly, quarterly, till the period that you have agreed to pay that premium. So that is what whole life do. Whole life allow your beneficiary to get a sum assured irrespective of your time of death. Even if you have finished paying the premiums, like the policy period has expired. But for term life is always for a period of time too. But for term life, your beneficiary only gets paid if death comes within the period of policy. So if you have chosen a 5 years term life policy and you're paying premium monthly, quarterly, half yearly, yearly for this period of 5 years, you need to die in this period of 5 years before your beneficiary can get paid a sum assured. Now you ask me, why should you go for term life? The main difference between term life and whole life is that term life is cheaper than whole life policy. So you can even get a term life policy whereby you pay 10,000 naira premium and your beneficiary gets 1 million at death. So it's quite cheaper than whole life policy. So that's basically term life. Now for endowment policy is like a savings plan. You're saving to get back your money at a period of time. So endowment is like, okay, I've chosen to do a 5 years plan. Whatever money I've saved in this period of 5 years, I'm going to get it back from the insurance company with interest. And if death comes in the period of those 5 years, my beneficiary gets the sum assured with the money that I have saved. So you may ask me, why do I need to do an endowment policy and not go and save in the bank? If you're saving in the bank, you know that banks comes with charges, deductions, but when you're saving with insurance company, you don't have these deductions. You get your money back with interest. And also, bank savings, when you are no longer in the picture, your beneficiary only gets what you have in the account. But for endowment policy, the beneficiary gets what you have saved with the insurance company and also with a sum assured. So this is going to be all for this episode. If you need more clarity, you can reach out to me via chat, you can reach out to me via emails, you can DM, send direct messages to me. I'm going to answer your question. And don't forget the exercises to help you with your insurance decision. Thank you for watching and see you in my next episode. And before I go, please don't forget to like, don't forget to comment, and don't forget to share this with your family, with your friends, with everybody. Thank you.